Hey everyone, it's Doug the Retirement Guy with all your monthly ETFs. And we get this video here, it's coming to you from comments that were made from our YouTube subscribers like yourself that we started pulling up and said, look, I'm getting the same thing over and over. Does leverage really win? TDAQ, an unleveraged fund, we know has been having a great performance. It's almost a year old. People have been excited about it. It's one of the highest, total return ETFs that we've been playing with, especially in the NASDAQ 100. Well, they did something earlier in the year, and they came out with TDAX, the leveraged version of TDAQ. So a lot of people have been asking, is it better than TDAQ? Can we take that 17% that we're getting from here and can we get it to 21, 22%? And we started asking this question and I'm like, wow, this is an interesting piece. And I hate to say, are people chasing yields? Are they trying to get the maximum potential? So I said, let's do a head-to-head comparison between these two and see, is TDAX actually improving? Is it giving us more than TDAQ? And what would we use it for? So today we're going to break that down. So grab your mug, fill it with your favorite beverage, sit back, and let's do the comparison between the TappAlpha's TDAQ and TDAX. Hey, before we go any further, I gotta do the disclosure that we're required to do, and this presentation is for educational purposes only. It's not financial, legal, or tax advice. Past performances do not guarantee future results, and I am not a financial advisor, so always, if you need hardcore facts, go to a financial advisor. Before we go any farther, if you don't have one of our mugs, this is what supports the channel. Simple thing, you can join our Patreon and do it that way, or you can easily just order a mug and enjoy your favorite beverage in the morning watching our videos. Use the QR code, use the link down below. This is partially, we have 11 ounce and 15 ounce mugs, and you can always get into the travel mugs, license plates, so many more things right at the website. Go check it out. So TappAlpha has TDAQ and they also have TDAX. Does that leverage really win? So we're going to compare the yields, the growth, the total returns, the strategy, the taxes, the retirement fit, how these things all go together and make things accordingly. So when we take a look at what's out here right now, I'm going to give you a snapshot of the two funds. TDAQ, which came out in September of 2025, so it's almost ready to have a 1-year birthday, uses an innovation, which is the NASDAQ 100 Growth and Daily Income ETF. The core strategy of this is the NASDAQ 100 style growth and daily zero DTE call income. Now, the distribution frequency is monthly. It launched in, as I said, September of 2025, expense ratio of 0.83. Probably the only thing on the fund that I really don't care about, other than the lack of history so far, is the expense ratio a little bit high at 0.83. In these type of funds should be about 0.2 percentage points below, and there is no leverage off of it. And the performance has been very, very strong. Well, we bring in something that came in January of 2026, at the beginning of the year. So this thing's about 8 months old. And that is called TDAX. It's the TDAQ Lift ETF. The core strategy seeks about 130% of TDAQ's daily performance. So it's almost like we're putting it up against its underlying asset. Now, this one does do something that I normally don't cover on this channel, but its distribution frequency is weekly. So it gives you that double enticing piece. Weekly paychecks versus monthly, 130% of the performance of TDAQ itself. So hopefully more income, more growth, more strategy across the board. The expense ratio, again, adding more to it, 0.98% expense ratio. And the leverage, and yes, it uses leverage and it resets daily. So it's always watching the market, what the market's doing, where it's going, how it's handling, and so on. So the key takeaways, TDX adds that leverage and that weekly cash flow, while TDAQ is the simpler, unleveraged core option base. Now, I want to just clarify right up front. Why am we talking about leverage? And what's the big thing with leverage? Well, leverage is a double-edged sword. It's great getting a positive extra 100, it's 130% or basically 30% more of TDAQ's performance. But what it also gives you is the opposite. That it's like the roller coaster. Going up the hill, we're going 30% higher. That means when we go over the hill, we're going 30% farther down. So it's good on the ups, bad on the downs. So we're trying to hopefully to get more up than the down cross of it. This is why a lot of retirement funds, we don't go after the leverage pieces. We don't fight after these. You see leverage used a lot in those weekly payouts. So it's just something that we don't cover here on this channel. I do it on my other channel, Doug the Retirement Guy, for the weeklies. So let's take a look at the strategy breakdown, how these two funds try to produce income and growth together. So TDAQ really bases off the NASDAQ 100 style core growth exposure with those daily 0 DTE call options income engine. The goal is a balanced upside with the potential for income. So that's what the funny part is they're actually trying to get growth with income versus growth. Now, TDAQ is built on the TDAQ concept, and it seeks 130% of TDAQ's daily performance. So they're using a little more aggressiveness. They're using that leverage to get it there. It amplifies the upside of the cash flow. Now, TDX is not simply TDAQ, but 30% better. The daily leverage changes both risks, income, outcome, all the way through. As I said, double-edged sword. If it was just 30% more, we would scrap TDAQ, go to TDAX, and be done. But at that 30% up, 30% down is where our killer comes into play. So why leverage doesn't always win? 4 reasons. 1, the daily reset. TDX targets 130 of TDAQs for one trading day at a time. Okay, so it's not doing a month, it's doing every day, one day at a time, it's making the change. And hopefully they guess or it does right as they go through. The volatility drag. Choppy markets can reduce the benefit of leverage. Remember how I told you 30% up, 30% down? Well, in volatility, you may not go up as high. Your downs may come even more. And you amplify your downs as much as you amplify your ups. Path for dependency. The route the market takes matters. Okay? The route that the market takes really matters, not just the ending point. It's that whole, I almost should have changed the picture onto it. It's the whole bar chart is the ups, the downs, the ups, downs, ups and downs. How many ups and downs are we doing? Is that path that we take, not what we started at the beginning of the day with and ended the day with. It's the path in between that really matters what happens, because you get a period, I always say at 10:30, there's always a nice drop off in the market for some reason. Well, if that market off is too big, you amplified it. Now it's going to take much more amplifying to get it back up to level point. The higher risk and cost. Leverage magnifies losses and adds complexity to it, which increases the expense, increases the bottom line. So in volatile markets, leverage can increase stress without meaningful improving results. So let's take a look at how we're going to compare these things, the yield and the payout comparisons. Well, TDAQ right now has a 17.1% distribution rate forecasted out. Pays out those monthly, strong income without the leverage. TDAQ is showing a 19.55%. Paying weekly, higher headline cash flow. So TDAX wins on yield, but the gap is only about 2.45 percentage points more. So you're gambling to get 2.5% more than the traditional TDAQ. Is it worth it? Now, are we chasing 2.5% of yieldage points and paying extra in expenses? It's a teeter-totter. It's a balancing effect. Are we really getting much for that gambling on leverage? Let's take a look at growth. TDAQ in the 6-month NAV total return is 10.29. The 6-month NAV total return, so I can compare apples and apples, is 10.53. It's only a 0.24%, quarter of a percentage point more with TDAX than TDAQ. So TDAX wins, but man, that's not much of a win for all the negatives that comes with a leveraged fund. Okay, so this is remember, TDAX launched in January, so the full 8 months is common history, does not really exist. So I backed it up to a 6-month period to give you guys an actual hardcore 6 months apple for apple comparison. Look at the total returns across the board. And this thing here, I went to year to date. So we're probably not even maybe 20 days difference between the two. So we started off with the brown line is TDX, the blue line is TDAQ. And you can see it's pretty much TDAQ has been winning the whole game across the board, been above for total returns, even as they were in the negative numbers back here in April when it dropped off. And you can see the effect of leverage right there. The drop off. Look at the big drop off in April, right virtually almost middle of your screen. You see the patterns are almost identical, but the drop off is just tremendously much more. Now it's taken a lot more recovery. And when we had from April all the way to about June, we had a strong recovery in the market. And you can see, even with the strong recovery, it takes everything the leverage has to get above or even equal to the total return of the fund. Now, when we get to late June, TDAX was above. And I think this is where people were starting to say, oh, better fund, better package. And we finished out the year almost copying each other to a T, up and down, up and down, up and down, and equal amounts. So here we are today, 15.59% total return from TDAQ versus 13.92% from TDX. So without leverage has outperformed the leverage fund. So why would you take and gamble for the big losses, trying to get the big gains, when through the entire year, about 8 months, we are actually about 2 percentage points more in a non-leveraged secured fund? Now let's take a look at taxes. Now, this is an interesting piece so far. And this is one thing that a lot of people didn't really, I think, when I've talked to them, don't really understand or know. But TDAQ in 2025, because they had a little bit of time that they could show. They used a return of capital, ROC, was 70.2%. That left 26% was actually qualified for Section 1256 contracts. Now, who else uses that? Simple company, NEOS. Which is why TDAQ has actually been on my radar and been watching it and part of my portfolio already and saying, I'm getting some of the advantages of NEOS. I'm getting higher income than the NEOS. And I'm using return of capital as an alternative piece, which they use as well. Now, 3.7% came in as qualified dividends to make up the 100% of your distributions. So it's a good tax burden across the board, spreading it out between ROC, 1256 section, and the qualified funds. Now, TDAX was launched in 26, so we have no tax history as of so far. Will they follow what TDAQ does? Probably doing a return of capital, probably closer to that 90, probably 96%. I would honestly guess. This is all guessing. Um, and I hate doing that in these presentations, so I will just leave it at there is no history of taxes yet, but they definitely are going to use return of capital. So let's take a head-to-head scorecard right now. For income, TDAX squeezed out a win by about 2.5 percentage points. Payout frequency, well, of course, we all love weeklies, but they haven't performed well. But we'll give that benefit to them as the weekly versus the monthly. Total return so far, well, in the 6-month package, it wins. In my 8-month package, it loses. So I'm being honest and upfront with everybody and say this is a win-loss. And not often do you run into these, but it's a win-loss. They win in the short period, 9 months. They lose in the 8-month period. So when we get a hardcore 12-month package, we'll do this again to give you a very clue exactly who wins and who doesn't. The risk control, though, TDAQ is going to win that game. The expenses is TDAQ, even though I still feel they're too high. Simplicity, TDAQ wins that one. And to me, a retirement core fit, TDAQ. And I just did a video on this with a gentleman who was looking to make this his core. I believe that TDAQ actually has the ability to be a core fit, especially after we hit that 12-month period. I think it could be. But a TDAX is not a core item, is not good for retirement. So I will tell you this, leverage boosts income, but it has not yet delivered a big enough advantage to dominate the full comparison. So I think everything I show here, the win is TDAQ still. I don't think leverage is really that strong of a piece. In a retirement account, guys, I gotta put it this way. TDAQ can be a core holding. It's got a simpler structure, a lower expense ratio. Again, even though I still say it's high, I have different ways of doing it. Add no leverage added to it, strong growth and income balance approach. While TDAX at best is a satellite holding. And what is a satellite holding? That is something that supports the core. You don't put a ton of money into it. You know, you can see things that you can see maybe a 20, 30, maybe at maximum 40% of like your NASDAQ 100 holdings is maybe 35% of your income bucket. Then that is 35%, and TDAX would only be maybe 30% of that 35%. I know it's a lot of numbers. So it's a very, very small holding that you would do satellite with the goal of trying to increase something of TDAQ that doesn't work well. Maybe it's income, maybe it's growth. You want to build that up. But that's why I say as a satellite, putting it somewhere, I would say you have to put it as a satellite, very small holding. The higher headline yield is what I think people are chasing. Oh my God, this is good at 17. I can get 20. Well, you're only getting 19. Weekly payouts, another big push for it that they think weekly is so great. But long term, remember in retirement, we're here for the marathon, not for the sprint. Okay, so I personally want to tell you, my personal opinion, TDAX does not belong in a retirement fund. It's for guys who want to gamble and play hard with it. It's a very aggressive risk profile. I don't suggest this in any way, shape, or form, but putting it into perplexes here, it's the only way I could play it in a game. So my final verdict overall, and for retirement accounts, TDAQ is the winner. I personally don't do anything with TDAX other than, again, on my other channel, we did the 2026 ETF challenge, and we did put that into the portfolio just to do a comparison to it because so many people asked for it. But I really, in retirement here, TDAQ is the only way, it's the only place to play. So I don't think leverage really wins. It may give you a little boost in yield. Didn't show this one, didn't show a lot, but for core retirement, TDAQ is a stronger choice across the board. Let me know your thoughts. Let me know your opinions. Do you think I'm right, wrong? Are you a TDX fan, or have you been burnt by it? Love to hear from you. Leave a comment down below, and we'll check you on the next video. Thank you for watching.